All right, third quarter, Dave.
Yeah.
What happened? What changed?
What happened? What changed? Well, I'll tell you. Things changed. Well, you might remember that we predicted that the third quarter was going to be a little bit tougher.
Yes.
And it was. Just by way of review, the federal first-time homebuyer tax credit expired for closings at the end of June. And so what you saw was a very predictable this and this in terms of activity.
Sure.
It had a very dramatic effect. Through June, we were up 25% in Dane County in terms of the number of home sales. And through the end of September for the year, we're down 2%. So we gave up all that 25% in 3 quarters and 3 months. So yeah, it was a very dramatic turnaround, and I guess it's to be expected. We knew it was coming. We knew that the federal home buyer tax credit was having a profound effect on driving people into the housing market, and now that it's gone, it's had a profound effect in the other way, and it's left something of a vacuum in the market. So this was all predictable. The question is, of course, how much longer it's going to last, and where are we going from here? And that's much harder to gauge. So far, we're taping this now in mid-November, and so far there hasn't been a lot of evidence that the home buyer is coming back to any great extent. But it's also seasonally the slowest time of the year, so it's difficult to judge. And we'll just have to see what happens. But it's been interesting, the whipsaw effect. I think looking forward to next year, to 2011, clearly we won't have that kind of whipsaw effect again. The federal government shows no indication that they're going to add another first-time home buyer tax credit or anything else like that. I think that's good.
Yes.
I think that was distortive of the market, and so it'll be nice to go through a year when we don't have those kinds of distortions, and we'll get a much better idea of what we really have. And so I think that's going to be a positive. But so far, beyond that, things are kind of a little bit of an unknown right now, and it's going to be interesting to see how things evolve.
So what about interest rates? They're low.
Well, the federal government isn't directly doing anything now to stimulate the economy, but the Federal Reserve certainly is. You've probably heard about QE2, which stands for the second round of quantitative easing. And what the Federal Reserve is basically doing is committing funds, borrowing, buying treasury bills, buying mortgage-backed securities. It's buying debt. It's creating demand for debt. It's expanding its balance sheet, essentially flooding the economy with dollars. Its attempt is to lower interest rates and to stimulate the economy. I think what the Fed believes, rightly or wrongly, is that deflation runs a greater risk for our economy than possibly inflation. And so I think pretty straightforwardly they're trying to get a little inflation going.
Yes.
I think it's exactly what they're trying to do. So far, they have not succeeded. In fact, the CPI and PPI numbers that came out just a couple days ago were very, very low.
Yes.
And so it lends some credibility to Chairman Bernanke's argument that maybe it's something we need to do. It has been a very controversial policy. And so far, the bond market this time around has acted kind of strangely. In fact, if anything, interest rates have kind of come up a little bit. Just this morning, the 30-year fixed rate was at 4.5%. And it was as low as 4.25% a few weeks ago. So we'll see. The 10-year Treasury yield has gone up, and we'll see if it continues up. And there are other things that are going on. We have problems in Ireland. We have all kinds of things that somebody's listening to this video a month from now may well not even be happening anymore. So who knows? Things are moving very quickly. But here's the key. Here's, I think, what home buyers need to think about. It's clear that the Federal Reserve is intending to keep rates low for as long as they can. And this is something that we didn't know they were going to continue to do 6 months ago.
Right.
So buyers need to think about 2 things. Number 1, interest rates are extremely low. And number 2, they need to bear in mind that they are low because the Federal Reserve is making them that way. This is not market-driven. This is policy-driven.
Right.
And when that policy is reversed, which it will be, once they're successful in kindling a little inflation, then you're probably going to see rates slowly rise. So you have a very unique opportunity right now that's going to last until the Federal Reserve changes its mind, is basically, I guess, what we're seeing, or until we see inflation start. The other thing to bear in mind is that if the Federal Reserve is successful in its desire to try to create inflation, that is generally good for hard assets.
Yes, real estate.
So real estate in an inflationary environment is likely to start going up in value. Am I predicting that real estate's going to start to go up in the next month or the next 3 months or the next 6 months? No, I don't know when that's going to happen. but it's pretty clear that it ultimately will. And right now you have kind of a confluence of events where we talked about in our last video and in the last newsletter about how real estate prices rose and then fell and are now kind of back on their normal inflation-adjusted path. So you have prices that are fairly normal, you have interest rates at historic lows. I've been beating this drum for quite some time, and eventually people are going to wake up and realize that, yeah, this is kind of the way it is. You know, don't always take my word for it. Morris Davis, who is an economist and professor at the University of Wisconsin, studied this and predicted 4 years ago that national housing prices were going to fall, and he was absolutely correct. And he's now suggesting, I heard him talk yesterday, the words he used were this may be a once-in-a-generation opportunity to buy houses at the most favorable terms you possibly can.
Yes.
He just bought a house himself, and so he's putting his money where his mouth is. John Paulson, who you've probably,
Right.
you heard him about the book, The Big Short?
Yes.
Yes. He made a lot of money shorting housing 4 or 5 years ago, like $1 billion or something like that. He's now saying, buy a house and buy it now, because he sees in Federal Reserve policy the likelihood that low interest rates and the possibility of inflation down the road is going to be good for housing. So the time is now,
Yes.
and I think that's pretty clear, and that's the policy of the Federal Reserve until they change it.
That also has implications for pricing, right?
It does. We've been very lucky here in Madison, and it's been interesting. I've been contending for some time that our prices here have been very low, have been very steady, not low, have been very steady. Our upside was very low, and so our downside has been relatively mild. We haven't seen 20, 25, 30% decreases in housing prices, and yet when I say that, it's really interesting. People say, oh, that's not true. There's just no way. That's just not true. I know they've gone down more than that. Well, here's what I know. I know that our median price, it was down about 8% peak to trough, and it's popped right back up again since the homebuyer tax credit expired. The Federal Housing Finance Authority, which tracks sale-to-sale changes in prices over the entire marketplace, has seen our drop in prices peak to trough at about 5% here in Dane County. That's what the numbers show.
Right.
So maybe prices, well, I shouldn't say maybe. I know that there are plenty of examples where prices have fallen by more than that. We know that. Certainly, when I make this argument, somebody will trot out the story of their friend whose property sold for a lot less. I believe it. I know it's true. I think in the very upper end of the market, the most expensive houses, my guess is the prices have probably fallen by more than that, 10, 15. It's a case-by-case basis. It's hard to know. Houses in that price range are very difficult to value. But clearly, there are examples where prices have fallen by more. But in the aggregate, in our market, we've been very steady. And when you compare that to the national trends, I think that the likelihood is that we'll probably stay level for a while. Our inventories remain fairly elevated by historical standards. Our building permits and whatnot are very low. We're not seeing a lot of building activity, so supply new supply coming on the market is relatively restricted in that regard. And so we'll just have to see what happens. But I think we're going to see prices relatively flat. If there's any downward movement in prices over the near term, it's going to be small, and it's going to be for technical reasons. Long term, if the Federal Reserve, as we've said before, is successful in its policy, they are determined to see housing prices start to rise again, and when that starts to happen, this opportunity will be gone.
What's the message for buyers?
Well, I think it's been pretty implicit in what we've said up till now. This is an incredible buying opportunity. And I know people don't want to take it from us. We're in the business, so the presumption is that we're going to try to tell people to buy. It's always a great time to buy. But I take a long-term view about housing. And you look at the pressures that are building underneath the market with incredibly low interest rates, the Federal Reserve trying to get inflation started again, high inventories, all those things, and an awful lot of experts saying that housing is the cheapest it's been in generations. At some point, people are going to have to own this, and people are going to have to move on with their lives. I think, again, could it go a little bit lower? Sure. But could it go higher? Absolutely. It could. Here's the rule. We've talked about this before. 1% increase in interest rates cuts 10% off your purchasing power. So which is more likely? That interest rates are going to go up 1%, they've already gone up by a quarter from the bottom, or the prices in a market where they've only fallen about 5% are going to fall another 10%. Which is more likely? And because they're, in terms of your purchasing power, they're going to about balance each other off. My assertion would be that interest rates going up is more likely than prices falling by 10% more. and from where they are. And if you're buying with a long-term view, which is what you should, looking out 3, 4, 5, 8, 10 years, our price is going to be lower or higher than they are today. I think most people would say probably not lower and almost certainly higher. And that means that somewhere around now is the time to do it.
Buy.
And if you miss it, well, then you miss it. But because once it starts going, everybody's going to be stumbling
Of
over
course.
each other to try to get to it again.
The herd is
They always
going.
are. The herd is going to go, and everybody seems to want to buy with the herd. I guess there's comfort in the herd. I don't know, but for those that don't need the herd, I do it now.
And sellers, what's the message for
Well,
sellers?
sellers obviously they're on the flip side of the problem. There are certainly people I know who would like to be buyers if they could first be sellers. I know stories of people who refinanced their homes and pulled more equity out than they think they can get out of it now, or they don't feel that they can move forward with what they think they can get for their house right now. I understand all that, and those people probably should stay put. I mean, we're certainly not going to suggest that somebody ought to move that isn't in a position where they can move the way they would like to. But there are a lot of people that would like to move, and in a market like this, if you're buying in a market like this, you're also selling in a market like this, so these things tend to work together. You may get less for your house than you want, but on the other hand, you should be able to get a good buy on the house that you want to buy in today's environment. So the question you have to ask yourself is, how much longer do you want to wait to get on with your life? Because that's really the question.
Right.
When we talk about moving, I think we tend to get way too caught up in all the financial rigmarole. We're all trying to play the margins a little bit and
Right.
getting the most out of it we can, and that's fine. There's nothing wrong with that up to a point. But let's get back to why we're doing this. Does the house you have work for you now?
Right.
If it doesn't, and your family needs to be in something different for whatever the reason is, maybe the thing to do is just deal with the market the way you find it and move on.
Right.
Because 10 years from now, you're not going to
It's not
care.
gonna matter.
It's not going to matter. So I think that really just being realistic and assessing your circumstances and saying, what do I really want to do? And then moving forward is really the best advice I can give you. And if it doesn't make sense right now, it doesn't. But if your life would really be enhanced, you maybe ought to think about it. Maybe just doing what you have to do. That would be my advice to a seller.
Great. See you in January.
Hey, Jim, thank you. Talk to you soon.